Hello, everybody. It's Wednesday, September 16th. We are coming to you live. It's 9 o'clock from Investing Education Academy with myself, Brent Simpson, and Leon Noble. Today, it has been a doozy of a market. So we're going to talk about it. We are going to discuss Snowflake and some of September's other IPOs that you may or may not know about. So Leon, if you can kind of give us the dive into content.
Yeah, so today was crazy. So today was the big IPO of the company Snowflake. They're a data warehouse company. Wall Street has been waiting on this. They've been tripping over themselves trying to get to this IPO. And what's crazy is and we're going to go into some information in a minute, but just saw the demand of it, that it was priced initially in the low 30s. It jumped to the 80s, then jumped into the hundreds, and then came out at over 200, but we'll go into that. But that just showed you the demand of this IPO. Snowflake, again, a data warehouse company, going from essentially $30 was the original demand up to 120, and then eventually well over 200. So just massive, massive demand. Everyone's looking at this. And then kind of the reason behind this is that everyone knows, cloud is the, word du jour, the word of the day, word of the year, probably the word of the century, cloud in there. So the three main cloud providers are Amazon, Google, and Microsoft.
Google, Microsoft.
Yeah, Amazon, Google, Microsoft. But they're not pure cloud plays. So, Microsoft, we all know Microsoft does everything, software, gaming, everything. Amazon is really an e-commerce company, but they have a substantial cloud business called AWS, or Amazon Web Services. And Microsoft has Azure, which is their cloud, but they're not pure plays. They have a whole bunch of other businesses. And Snowflake is a pure play cloud. All they do is cloud data warehousing. And so, that keeps costs down. Cloud providers, software providers typically have high profit margins. So they're not weighed down by a lot of the legacy things that those other three companies have. So, yeah,
however, wait, we should also note that Snowflake actually does use some of their services.
Yeah, so Snowflake is so it's called SaaS, software as a service. SaaS is the acronym. So their service is delivered over the internet via the cloud, and they use Amazon, Google, and Microsoft's cloud to deliver their service. So they actually sit on top. They're a service that's provided by the underlying clouds, but they're not actually a cloud provider. They're a cloud providing service. So and it's kind of interesting that so the term frenemies, friends and enemies, apply because so Microsoft, Amazon, and Google, they all have their own data warehouse products as well, services as well. But and Snowflake is a data warehouse company, so Snowflake actually competes with the companies that help deliver their service. So, like I said, they're kind of a frenemy in that they're a friend to these companies, but they're also an enemy because they compete with them. So they're in a kind of a weird space, but again, they're a pure play cloud provider of data warehousing services, where the other big three actually have a whole bunch of other legacy products and costs too. So, so Brent, you can throw up slide one when you get a chance.
Yep.
And today's a crazy week because I think there are 10 companies total that are going public this week. We're just gonna kind of list off I think the top 5 that went out this week. But some big names in the private equity space that a lot of private equity firms in Wall Street know about, that invested in these companies early before they went public. But now they're actually hitting the public market now, and all of us are seeing it. None of us got the private equity deal, which is, people got the stock at those levels in probably $1-2, maybe even cents.
Yeah, so and one of the things we're working on inside the platform is if you're a member of IAA, and especially if you're a Panther, that in that group we're actually buying into private equity deals now. And so when companies like Snowflake IPO, we're guessing if we start now, maybe in 5 years or less or more, we have a day where there's a Snowflake, right? And so just right now, know that inside of the Investment Education Academy platform, we are buying into private equity deals right now. And those are deals that we only talk about in the platform, but we're trying to get in before these companies IPO. And to that end, we found actually some very promising platforms that may allow us to get in right before the IPO hits.
Yeah, we're actually looking to get into companies like SpaceX, Airbnb, kind of those household brand name companies that all of us know about, and so like for instance, a Snowflake, a company like this, the resource we found may actually be able to get us into companies like Snowflake way before they hit the public market. So we'll be presenting that to the portfolio Panthers inside the IEA membership coming in the next weeks and months.
Yeah, and also,
So okay, I'm sorry. Go
one
ahead.
thing we should tell them, for those of you all who are wondering how companies even make it to IPO, right? Well, let's not just dive right in. There's actually filings that have to happen, S1s. You have to release your financials to the SEC. There are auditors that come in. It's not, for those of you all who think, oh, people start companies and just launch. It is not that simple. This is just a really, really, really rudimentary breakdown of how some companies go about going public. They start doing business, of course, and they do a friends and family ask. They may do a crowd fund, but those are normally people just giving money to the cause because they believe in it. Then they do what's called private equity offering sometimes. That private equity offering is now where they either issue convertible notes or they're issuing debt in the company, or they may be issuing actual securities. It depends on the offering. In that space, when you get into the private equity realm, there's still another layer of financials that needs to go in, not as robust and detailed as it would for an IPO, but there is some regulation starting to happen where people are looking at, how you maintain your books, how are you accounting for really the business. Then you go through anywhere from a series A, G, I think A, B, C, D, E, F, G. I think it's all of those series offerings, and then you can get up to a place where you're thinking about IPOs. So that's just, again, that's rough. Not every company follows that model, but it's roughly, it's called a regulation. Some people also call it a regulation A, or a series offering. Just depends.
Yeah, just touch on that. So there's something that came out in 2012, signed by President Obama, called the Jobs Act, JOBS Act. And basically what it allowed for companies that were not public. So what happened? So within a situation like Snowflake, right? The companies that got into Snowflake before the IPO were like hedge funds, pension funds, mutual funds, the big boys, the big institutional money that got into these deals before they go public. Well, in 2012, Obama signed something called the Jobs Act, which allowed non-accredited investors, which is all of us, more, not say all, the majority of us, I think it's 93% of the US population are unaccredited. And accredited just means, I believe it's like you have a net worth of $2 million, or you make over $250,000 a year. So unaccredited, non-accredited is like 93% of the population in the US. So what the Jobs Act did was allowed, unaccredited investors like a lot of us to now invest in companies like Snowflake, and like Zoom, before they actually hit the public markets, to get to kind of, because the problem is that a lot of the juice is squeezed out by the time they hit the public market. So companies over the last, I think, 10 years, like 10 years ago, companies were going public at about 3 to 5 years of their existence. Now that since we have all this VC venture capital money sloshing around in the private equity world, companies are raising billions of dollars in private equity and then staying private for that's upwards of 10 years now. So they're having all this growth happen while they're private, and then they go to the public markets. But it's only the investors who invested really, really early in the private market that can get that benefit and those valuation raises while they're private. Then when it comes public, a lot of the growth's already happened, and you're just kind of dealing with a company that's kind of just floating at that point. So the Jobs Act kind of did away with all that and allows us to get into some of these deals earlier. It's still hard. Not saying it's easy to still get into. Some of these companies don't actually still don't open up their offerings up to the general public, like Snowflake. Some of them are still kept private for big money, but Jobs Act does make it a lot easier now. Yeah. So Snowflake. We're gonna go over Snowflake now. So here's some this chart has some stats that went down today and in the past. So start at the top. So the IPO price was $120. Now I want to make the point. A lot of people think that a lot of people get confused. And I used to get confused over this. So Snowflake came out. It opened up the market today at $245, but you see that the IPO price was $120. Where's the discrepancy? Well, what happens is the IPO price is not the price when it hits the market. That's the price. That actually be labeled the pre-IPO price. And what that is that's where the price is set before the company goes public. So again, pension funds, hedge funds, mutual funds, they bid for the price before it hits the public market, and a price was set at $120. That's the IPO. The IPO happens before it hits the public market. They raised $3.3 billion via that process. At $120, I believe it was 28 million shares. They raised $3.3 billion. That has nothing to do with hitting the stock market. That's just the IPO that happens before the shares hit the market.
Yeah, and for those of you all who are, thinking, well, I saw, Snowflake when it was saying $75 to $85. That was not set yet. And for those of you all who may be going back even further, I remember when the sentiment around what they were going to come to the market was $32. That also was not set. So there's a lot of discussion that happens before a company makes it to the actual public offering, and that has to do with valuations. They continuously do valuations, and based off of the numbers they come up with, based off SEC regulation, they can then change what the projections were for the IPO price until it gets set.
Yeah, it's basically an auction process. It's just supply and demand. So like Brent said, initially the supply and demand had the price around $30 some. Then as demand came in and demand jumped, the price jumped from 30 something to 70 something, then to $100. So it's just an auction system where it's supply and demand. There's more buyers than sellers, which is pushing up the price. Eventually, the price got to $120, and the underwriters and Snowflake agreed, okay, that's where we're going to stop at, and then we're going to then we're going to actually list the shares in the public market. Again, the IPO happens before that. $120 times $28 million is $3.3 billion. They raised that prior to coming out and going public today. So the IPO actually happens before the shares are listed on the public market.
Yeah, and I like to unpack this just a slight bit more, but not to confuse situation. I got a text earlier today, and it asked, well, what does par value mean? And so par value for a lot of these companies is honestly just the price that they set for their shares when they've originally incorporated. So like, depending on whether they created a C share or a C corp or S corp when they first decided to go public, depends on whether they set a par value or not. Oftentimes, it really has no basis for why they create the number. It's normally extremely low, and it's before they go through the whole valuation process. So when you think about, even when we're talking about these private equity deals, right? The first deal Leon and I got into, it was, how much was it per share?
55 cents.
55 cents a share, right? And so the valuation for the company, I think, came in somewhere around 22 million, somewhere in that realm. But the valuation has happened again, and they're coming in at about 29, and they're steady going up. They have now started to discuss going public. And when they go public, Leon and I are locked in at that 55 cent a share mark. So imagine like how Leon said, it's kind of an auction that occurs, and the sentiment changes, and then eventually they get to this final number. So some of these people, like we are, locked in for this one company at 55 cents a share. If it IPOs at 120, everything, I mean, we're talking about $119.45 of equity that we immediately have, beyond the extra $125 that it goes to the market at. So just keep that in mind when we talk about what happened today with Snowflake.
Yep. So yes, the IPO price was $120. So they raised $3.3 billion. Now today the stock opened at $245.
That's correct.
Which is, I mean, it was 100. I think it's like 105% jump. So what that means is, for those people that got the IPO price, remember that's prior to it listing on the exchanges. They paid 120. It came out. It opened at 245. So if they sold immediately, they banked 100 and some odd % return, overnight.
Or more.
Right now. The high for the day was 319. So if they held up to 319, I mean, do the math. Like, I mean, the return is ridiculous.
It was over 136% rate of return at the highest point.
Yeah. Yeah, yep, at its highest point, so 136%, which is crazy. So the people that got in prior to the IPO, either got in during the IPO or before the IPO, just made an absolute killing. So again, 120 was the IPO price, raised $3.3 million. It opened at 245. The high for the day was 319. So it closed today. I forget what it closed at, but
I think it was one. Let me check. I had it.
Not be 200.
231.
231. Okay. So the valuation of the company is $70 billion. Right. And
253, Leon. It was up 253. It was up 111%.
Right. From that 120. Yeah. Yep. So whoever got in at that 120, even if they held for the day and missed the high, they still made 112%. I mean, and essentially overnight, which is insane. I mean, remember the market on average returns 10% per year, so ridiculous. Crazy. Yeah. So you go back to the slide, Brent.
Yep. Actually, you got to see this. So this is what I was looking at beforehand. I have to show it. It was insane. This is the one day. The top was 319. That's just amazing.
And remember, the IPO price was 120, and then the market price was 245. So anybody who bought in early, again, pre-IPO made a killing. Even if you bought it at the IPO price and held and kind of day traded it, you still made a great return from 245 to 319. Yeah. So it was a monster run today. Okay, so table to close, its valuation is $70 billion. So I put in parentheses there next to the valuation that just kind of give a perspective. So GM, General Motors, and Ford Motors, the car companies that have been around for 100 years, they own assets, they have plants, they have parts, they own machines, they own cars. I mean, they have assets throughout the yin yang. Combined, put those two car companies together, and they're worth $70 billion. Now that's the same valuation as Snowflake that just came public today. It's only been public less than a day, and it's worth the same amount as Ford and GM, two companies that have been around for 100 years and have assets all over the world. I mean, and remember, Snowflake only has I think 1,500 to 2,000 employees, I believe, and Ford and GM have I think hundreds of thousands of employees, offices all over the world, and like I said, tons of assets. And Snowflake is worth by itself the same as those two car companies combined. I mean, just an unbelievable valuation. And I was saying to our members in the platform that in my mind, and by any measure, Snowflake is grossly overvalued. But that doesn't mean it can't go up, because Zoom is overvalued. Tesla is also overvalued, but we've seen what those have done. So just a bit of information there on its valuation. Now, as far as revenue, so this is what everyone was tripping over themselves for to get to Snowflake. So in January of last year, January 2019, revenue was $96.7 million. Fast forward 1 year to January of this year, revenue jumped from 96 million to $264 million, 175% revenue growth. That's what had everybody on Wall Street tripping over themselves and just really tripping over this offering, because Snowflake is a classic growth company. But growth companies typically, I mean, a good growth company, you're gonna see earning, you're gonna see sales, you're gonna see profits of maybe 20 to 50%, and then revenue of maybe 15 to 30%. To get revenue of 175% in 1 year is ridiculous. So this is what had Wall Street so excited about Snowflake. Another point I want to make real quick is that another reason that people are really tripping over this offering and growth stocks in general is because of interest rates, right? The Fed lowered interest rates to essentially zero. They actually came out today or yesterday and said that they effectively will not touch rates, and touch, they mean raise rates, till at least the minimum 2023. So we're talking another 3 years of rates being essentially zero. So any interest-bearing assets, you'll effectively get no return over the next 3 years, maybe longer. So treasury bonds, checking accounts, savings accounts, all those are basically dead money for the next 3 to 5 years. So that's why everyone is just clamoring for these deals, these growth stock deals, because the returns that you see, 175% revenue growth, which is going to translate into a stock, appreciating considerably. Everyone's tripping over themselves to find this yield to get that return. because there's basically no place else to go.
Yeah.
So that's one of the reasons that Wall Street is really clamoring over this deal.
That's actually why Wall Street as a whole has become so popular recently. I'm sure anybody who's watching us has seen the quote unquote gurus pop up, and they're trying to teach everything from what the stock market is to how to buy options to forex trading to everything else. It's really, this is the time where you want to educate yourself as a consumer and the retail investor, especially the Robinhood investors. The term Robinhood investor came about because it was such an emotionally charged platform for retail investors to buy and sell. And so you have these seasoned, really accredited investors who are watching Robinhood investors kind of go by the tide. I mean, just go with the tide. And they're not manipulating the system, but they know emotionally what's going to affect a new investor, and they're capitalizing on it. You really, really, truly right now want to educate yourself as an investor. This isn't solely a pitch for Invest in Education Academy. We don't care. We said it all the time. We don't care where you get educated, but educate yourself, or at least get familiar with the market and understand not only how the market works, but the emotion attached to it. Because if you can understand the emotion and get the proper mindset when you invest, that's when you win. When people come into Snowflake and it shoots up, and this is what we've seen, Leon and I've seen this happen. People think, oh, it's going up, and they double down. They think, oh, it's going to stay like this forever. Like, as soon as it came out, it went on this tear, and there's no way that a company like that is going to come back. And then all of a sudden it comes back with a flash, and you're negative, or you tried to trade on margin because the news was this. Just be educated. Don't get too caught up in the excitement of the deal, because as Leon said, the valuation doesn't make sense. And I 100% agree. And for those that are in our platform, we predicted it was going to go over 200. Like maybe 2 days ago, we said it's probably going to break 200, and it broke 200. And so we also talked about the pullback. It's coming. I don't know when, don't know how, but trust me, with that much profit inside of the stock and intrinsic value that's just bubbling, people are going to want to take the profits. Also, when investors, and Leon talked about employees, a lot of these employees when they first came into Snowflake were paid with stock options. And so at some point, the flag or the holding period is released when they can actually sell it in the public market. So when that time comes, you might see a huge flood of sales. So there's certain things in place that restrict, immediate dumping of corporate shares, but no one knows when that gets released. And, you just want to be careful that you don't get too caught up in the emotion, because it can trade very sporadically. And Leon, we got a question from Malcolm, and he said, when the company seems overvalued based on the information that you have of the evaluation, how do you really determine if the company's what the company's real value is? Is it subjective? Yes, to an extent. Companies will oftentimes correct back to where their financials suggest they should be. Sometimes, not all the time, but also we're not in the same marketplace where a company with a PE ratio of 12 is exciting. It's not that kind of marketplace anymore. We have companies that may have a PE of like 200, and it's still a good company to buy. And also, you think about Tesla and these splits that occur. When splits happen, and this Leon, you've seen Leon and I grit our teeth when talking about this. There's actually nothing that has happened to say this is a better company. It's just they announced they're splitting. People think it's more attractive, so they go buy it. That is subjective. It's actually kind of manipulation in my mind. I think it is, but there is a lot of subjectivity to how stocks do. There is some element, and these are my words, that the stock market has an element of a popularity contest. And if it's in high demand, it's in high demand. Leon, you got any thoughts?
Yeah. So as far as valuation, you can use PE, you can use regression, you can use sales. There are a lot of ways to value a company, but again, it's still it's still kind of subjective. Like if you use PE and you tell me a PE is 50 and I tell you a PE is 30, by the letter of the law, the PE that's 30 is better than the PE is 50. But if you've been in stocks where you've been in high PE companies and they've done well you really don't care. Like that the higher PE doesn't really matter to you. So I say that to say valuation is really subjective. Like it's whatever metric you use, you should stick to it. Like I wouldn't jump from PE to then using sales ratio or revenue ratios. You want to pick whatever your valuation metric is and stick to that, because you can't just jump around. Like then it really becomes subjective. So as far as valuation, I mean, if whatever my valuation metric is sets overvalue, I then won't buy it. I'll wait for a pullback. A pullback will happen when, I don't know, but it will happen eventually. Nothing goes up forever. So yeah, I mean, things that are overvalued to me, I generally don't buy. I just want to make one quick point about, and speaking of valuation, about this IPO. Actually, 2 points. As Brent said, high flyers like this can come down, can crash and burn. A perfect example of that is Facebook. Facebook, I forget what it came out at when it came public, but it went up to $37. I think it may have come out around that point, and then tanked to $18. It dropped 50%. 50%. Facebook tanked 50%, and it languished around that $15 to $20 range for months. I mean, people were like, "Oh, Facebook's a flop. It's never going to come back. You know, this whole social media thing doesn't really work." And look at Facebook today. So, I mean, you know, whoever missed out on that, missed out on that. I mean, I was one of them.
Well, but I was one of them that bought it. And so let me tell you about the emotion of Facebook when that did happen. I was like, oh my gosh, like I made a huge mistake. However, and this is where I say this is the difference between kind of investing in what you know versus investing solely based off of what you heard or just purely numbers, right? I knew I used Facebook. I knew I was still using Facebook all the time. I knew my friends were using Facebook. I knew my centers of influence were using Facebook. So I just wrote it out. Today, my return on investment for Facebook is over 468% rate of return. And I'm not saying that to say, ooh, but I'm saying to say, I had the same fears initially, like, did I make a bad choice? But I bought something that I also supported and used. So the emotion of maybe I should bail didn't surface and didn't cause me to make a bad choice. Leon, you said you had 2 points and I didn't want to interrupt you.
Yeah, no, second point was, I just want to say about Snowflake was that, so, you know, we were talking about valuation with Mo's question, but the greatest value investor of all time, Warren Buffett, right? He only typically, you know, not always, but typically he only buys things that are undervalued. Warren Buffett today committed $250 million to buying Snowflake at $245. So Warren Buffett made almost $250 million commitment to buy Snowflake today at the opening price of $245, not the IPO price of $120, at the opening price of $245. And so huge investment. So I'm saying that to say the greatest value investor of all time even saw this as like, Warren Buffett knows it's overvalued, but he also knows that when he's in for the long term, and two, you know, the market that Snowflake is playing in, it's cloud, it's database, it's data architecture, things like that, things that aren't going anywhere. And so Warren Buffett investing in this was a huge endorsement for Snowflake. Also did CRM, the company, what they call
CRM, yeah, Salesforce.
Salesforce invested in Snowflake today as well with $250 million. So huge endorsements for Snowflake on the corporate side before the IPO even happened.
And Leon, we got a question. Is it Arthea? Oh, Kia asks if you can explain PE, price to earnings ratio.
Yeah. So PE is a way to value a company. So PE just stands for price to earnings, right? So all you do is you take the price of the stock, price of the stock, and divide it by the earnings per share of the stock, and that'll give you your price to earnings. Another way you can do it also, you can take the market cap and divide that by the company's overall profits. So, you know, if their market cap is like, you know, 2 billion, you divide that by their profits of, say, I don't know, 300 million. But you generally take the price of the stock and divide it by the earnings per share of the stock, and that'll give you the PE value. And PEs are typically, I mean, the PE for the S&P 500 right now is about 25. And the PEs, so typically PEs are you want lower PEs, right? So if a PE is like 50, 75, 100 versus a PE that's 20, 25, 30, you want the lower PE. Because what a PE tells you, essentially it tells you how much you're paying for every $1 of profit a company makes. So you want to pay $30 for every $1 versus $100 for every $1 profit a company makes. So just know that when you're looking at PE, the lower the PE, the better when you're comparing companies.
Up to a point. So there's a point where you get to a PE like 12 or below, and you got to wonder what's going on with the financial health of the company. So it's not like if you have a CPE of like 1, that's great. So it's up until a point.
Generally, it's You want to see PEs. I mean, typically PEs run between, like Brent said, 12, 15 up to. But now with growth stocks and tech stocks, you can have PEs run into the hundreds. But again, you gotta know, like a company like Snowflake, if they had small profits relative to their stock price, their PE could be like 200, right? But it's Snowflake. It's like it's the new hot thing, and you put some money into it. It's a fast grower, and what everybody's betting on is that eventually their earnings or their profits will catch up to that stock price, and it'll be worth it in the future. So as I said, Snowflake is overvalued, but so is Zoom and Tesla. And we all know what those stocks have done. So, overvalued doesn't necessarily mean it's a bad stock.
And this is one of those times where I would say, Leon is a huge proponent of understanding the sector before you invest in a company. When you look at a particular sector for stocks, this is a great example to say you can also look at what is normal and what is abnormal. So, what might be normal in a tech sector is not normal in a home building sector. So you need to know the sector in order to know whether the numbers you're looking at make sense or are they outrageous, because depending on the sector, it will change. And
that's
so,
great. Oh, sorry, go ahead.
No, you go ahead. I know you're gonna say something about the sector. So
that's a great point because so the question about PE. So like in technology, if you're looking at the technology sector in general, on average, the technology sector may have PEs of like 90, right? And that's the average. So then, like Brett said, home builders, their average PE may be like 25. Mm-hmm. So if you're looking at, you can't really compare somebody like a Home Depot or a Lerner or a Toll Brothers home builders. You can't compare that company to like Zoom or Snowflake because they're two different sectors and those PEs are going to be way off. So you always want to compare apples to apples. So in a case like Snowflake, you compare Snowflake's PE to somebody like, again, Zoom or Microsoft, not to like a Home Depot or Lowe's or a Toll Brothers home building. That's a good point, though. It's apples to apples. You want to compare companies to their sectors and companies within their sectors, but not companies outside of it.
Yep. All right, and we have another question. Well, it's kind of a statement, so we're going to respond to the statement. There are always market manipulators ready to take your money. You can either lose or win big or lose big. It depends. There are market manipulators, but normally when a stock is going to be manipulated, it has a really small volume. So if you have a stock that has an extremely small volume, those are much more susceptible to being trading volume. That is, they're much more susceptible to being manipulated than when you get into stocks that, maybe have like tens of millions of trades per day. It's much harder to manipulate that stock. Now, when you talk about governmental risk or understanding if there's an inflationary risk to a company, that's a lot of that is private public information. So yes, there are people who will manipulate the markets. Yes, there are people who will receive information before you and I do. Yes, some retail investors don't necessarily get the information like when it's still fresh. However, by and large, I just want to be very clear, Aretha, with the statement that everyone listening to this understands that the market overall since its inception has returned roughly 10% per year. And right now, when you're looking at, as I'll call them, like trash investments, being anything traditional, like a bank account right now, savings account, you're dying a slow death financially. And so I'd rather be in an environment where there is some risk where maybe I'm not first to information market, but overall I still have a higher probability of winning than be comfortable dying a slow death. So I know that's not what you said, but I want to be very clear about that. The market is one of our best chances. The market, real estate, and entrepreneurship are our best opportunities to kind of narrow this wealth gap that exists right now. So I want to be very clear and address that statement.
Yeah, and market manipulation it's not a myth, but it's way overemphasized and overstated. It's almost like saying when people say that day trading, like you see online, everyone that day trades makes $1 million a day, right? Like it's ridiculous. Like it's almost like a parody of itself. And market manipulation, as Brent said, on stocks, on penny stocks, yes, it's common and it happens. When you're dealing with stocks that trade millions of shares per day, or even some trade hundreds of millions of shares per day, market manipulation is almost non-existent because in order to move that stock, you have to have billions or hundreds of millions of dollars to be able to influence a stock. And only companies that can do that are hedge funds, mutual funds, or banks. And those are wholly and highly regulated areas of finance. So those companies are not in the business of trying to break the law and put themselves out of business and go to jail, right? I mean, they're sitting on billions of dollars. They're not going to risk their whole $1 billion enterprise on trying to move Snowflake $2 to make a couple $1 million. Like it doesn't work like that. It doesn't even make sense. So this notion that there's all this manipulation in the market in quality stocks that trade millions or hundreds of million shares per day is really non-existent. It's almost a myth. I mean, not saying it doesn't happen, not saying it hasn't happened in the past. But manipulating a stock with volume, like as Brent said, that has high volume, like Snowflake, like Microsoft, like Tesla, the manipulation side of trying to move the price artificially is almost non-existent. You'd have to have billions and billions of dollars to do that, and you're risking your firm, and you're risking losing also billions of dollars trying to do that. So it doesn't even make sense on big companies like this.
Yeah, and on the inside, when you start looking at what we said earlier, there's periods in regulatory periods where insiders can't even trade. So they try to control insider trading as well. SEC, FINRA puts rules and regulations in place where you can't really have insiders manipulate the price like they did in the 20s. And really with the invent of the NASDAQ, which is going to take us down a whole new thing. But in the early 1930s, the NASDAQ came to market. It replaced the old ticker tape they used to track ticker symbols, which were stock companies. And when that event came out, that's also when the SEC came about, and the SEC then began to regulate how insiders were distributing information, because before the NASDAQ, it was really easy to manipulate actually a ticker tape, which was a piece of paper that showed what was happening with stocks. And to elevate that, or to evolve that into today, companies have to file with all the insiders who own stock, and they only are allowed to trade at certain points until after a given date where they can trade openly. Even then, it's certain percentages of blocks of shares that they can only sell at a time, and often they have to make the SEC aware that they even intend to sell, so they can make it public information. So
yeah, I mean, it's a lot harder today to manipulate a stock than it was even 10, 15 years ago. Like, I mean, the regulations are I mean, to even go public, costs almost $1 million, right? So, and that's based on regulations and fees and fine, things that companies have to pay. So the SEC is really locked down on a lot of that manipulation. Like you said, on penny stocks in the OTC market, the pink sheets market, it's a whole different world. But the general stock market with the NASDAQ and NYC, it's really rare these days.
Yeah.
Okay, so
I'm gonna jump to slide 2 just because we got off.
So. Well, I just want to point out the losses. I just want to make that, because what we're going to do. So just real quick. So Snowflake, you saw, has 175% revenue growth, which everyone was tripping over themselves to get to. Now, the other side is the losses. So Snowflake is not profitable. They're nowhere near profitability. Just want everybody to know that. So in January 2019, their losses were $178 million. A year later, January of this year, that went up to $348 million. So almost 100% growth in loss, or 100% increase in losses. It grew by 95%. Now I look at that and maybe like that's pretty bad, but the way I look at it is their revenue growth was 175%, and their loss increased 95%. So the revenue growth is far outpacing their losses. Now the losses did grow. I mean, that's still a negative thing, but what everyone loves is that rich revenue growth, because at some point losses can be mitigated and can be eliminated. There are many ways to do that, but this is a growth company who's investing back in their business, so that's why they're showing losses right now. So I just want to make that clear to everybody. They're not profitable, they're not near profitability, and they do have losses.
Yeah. And Beverly put a comment in and said insurance too. There are so many ways to make insurance a hedge against the market to still experience growth while insuring yourself, loved ones. That's like a course within itself, or a lab within itself. Leon and I actually are working on bringing some of that information to market, because life insurance is an amazing platform to actually hedge against the market, and or have an alternative for quote unquote saving money for later on in life. And you're absolutely right, Beverly. That life insurance is included in that. It's just some people don't know how to create the living benefits of it, and they only look at it as a death benefit platform. So we really didn't mention it. And the ones people are most familiar with are real estate, entrepreneurship, and the stock market. But you are correct. Life insurance is amazing. And we're working on bringing some more information to you all about life insurance platforms.
Yeah, so here is what this is showing here is these are some of the IPOs that came out this week. I believe there were 10 or 15 this week, but these are the kind of big names. So the first one is Unity Software. So the symbols inside the parentheses, those are the stock symbols, the ticker symbols. So anyone who wants to go look these companies up, just put in the symbol in your platform, it'll pull up. Unity Software is a 3D video game developer. I'm not sure if they're out yet. Like I said, just look it up. Amwell provides telemedicine.
Unity Software, I think they announced today that they will IPO soon.
Okay. All right. So yeah, I think like I said, I think all these they're either out or they're going out this week. So some of them may not be public yet. So Amwell provides telemedicine services. So a few weeks back, we picked a company called Teladoc. So Amwell is similar to Teladoc in providing telemedicine services. Sumo Logic, they're a cloud data analytics provider, and JFrog develops DevOps software or development operations software. This one, so JFrog actually came out today. I think they came out at 40 and ran up to 70. So I believe they jumped pretty high today. But they had a lot of demand and a lot of excitement around JFrog too, just because of the software they provide to developers. So they were really in demand today as well.
Yeah, and everyone, we can't go too far into this, but I do want to let you all know, if you're buying into IPOs before they release, most brokerage platforms will demand or require you to make a limit trade. You cannot place an open market trade for IPOs in almost 90% of situations. So we ran across a couple people, sent us messages saying they can't place a regular trade. They can only do a limit trade. What does that mean? It basically means you have to set a price on which you're willing to pay for the stock. The reason they do that is because outside of having a margin account, if you don't have enough money to cover what happened with Snowflake today, they said 120. Imagine if you placed the order thinking, oh, it's the order for 120. I'm gonna place an order for 10 shares. And all of a sudden that 1,200 you thought you're going to need turns into $2,450. That means that either you possibly could not have enough money in and some other things. So in order to protect you and the brokerage accounts, the brokerage firms from running into that problem, most IPOs require a limit order. If you want to know more about how to do limit orders or what they are, send me a direct message or Leon a direct message, and we can direct you to Invest in Education Academy. And inside the platform, we actually are talking about those things.
Yeah. So all right. So the key takeaways today are that Snowflake SNO is the largest software IPO in history, raising $3.3 billion. So we all saw history made today. Some people participated, some didn't, but we all saw the craziness go down. With interest rates near zero, investors are willing to pay up for yield. And what I mean by that is basically that what happened today. The IPO price was 120. It hit the market at 245, and then it ran up to 319. And the reason that happened is because, again, there's no place else for people to put their money. The Fed cut rates to effectively zero. So checking accounts aren't paying anything. Savings accounts aren't paying anything. CDs aren't paying anything. The only place to put your money right now.
They're paying very small.
Well, very low. So, yes. When I say not paying, they're paying very low. They're paying close to zero. Yes. Yeah. Wait. All those, like I said, anything that's interest bearing, you're getting a very, very, very low return. Less than, a lot of cases,
less than 1%.
Yeah, less than 1%. Yeah. So investors that have, all of us and people that have billions and millions of dollars, they're chasing yield, they're chasing return. And so the only place to go right now really is the stock market. So, and the holy grail in the stock market are growth stocks. These stocks that grow 10, 20, 30, 40, 100% per year. A company like Snowflake is that, and it's a tech company. So investors are like I said, tripping all over themselves to get to these stocks because there's no place else to put their money. Because of the willingness to pay up, companies are rushing to go public. So today, I think this week there are like 10 companies. And the one below that shows there that there were 235 IPOs in 2019. This year, there have been a little over 100. And that's only because of COVID, right? So had there not been COVID, we would have seen a whole lot more than the couple, a little over 100 we have now. There were 235 last year, which was up from 2018. So what companies are realizing, they're realizing what I just said. Look, there's no place else for investors to put their money. So investors are willing to pay top dollar right now for stock, right? So if you can come, Snowflake just raised $3.3 billion. If you're a tech company, you're looking to raise money, now's as good a time as any, because investors are throwing money at companies, especially tech companies, but companies in general. So because interest rates are so low, this is a great time to raise money because investors have no place else to put their money. So those are the 3 or 4 takeaways from this podcast.
Yep. And again, I know some of you all clearly from the responses and the numbers who are watching this, there may be a lot of questions about, how do you get into IPO? What happens if I get locked out of the price? How do I know it's not rigged? It's a lot of questions around it, and it's too many to answer right now. And we see the questions kind of still popping up, but I want to say you really want to get with the community, and if Invest in Education Academy is that community for you, you can find us at IEAmembers.com. Again, www.IEAmembers.com. And in that space, we talk about these things. We went live to talk about Snowflake. That was recent, right? Like 2 days ago, last night?
Yeah, 2 days ago, we did a live for our members discussing the Snowflake IPO. And like Brent said, pretty much what we predicted happened, what happened actually happened. So a lot of the IEA members were prepared for what happened today.
Yeah, and the reality is, if you're not part of a community in this marketplace, emotion can get the best of you. We've had some of our clients or some of our members come in and actually have conversations with us, like conversation with the community, like, hey, this is what I'm thinking about doing. What do you all think? And some people agree, some people don't agree. But if you understand the reason why we're doing this is not like this huge money-making thing. We're going to make money because we invest in the market. So we're going to be fine. But we know it's a lot of people who really have a desire to be in the market, but they don't fully understand it. And what we're learning is when you're part of a community, I'm still learning. Like there are times where some people have put up ticker symbols, companies I've never heard of, and I invested in them. I've done pretty well. So I thank all the members for listening to information. But the information Leon I put up is designed to help you navigate this thing called the stock market, right? And so with that being said, if you are looking for a home to learn about investing in education, and I see Brian Olds, he's the creator, owner, CEO of Black Speaker Network. He said IEA is a no-brainer. So if somebody like him is saying it's a no-brainer, then I guess we're doing something pretty well. So what you all want to know is, what are the picks? So Leon, did you have anything to say about that, Leon, before I just jump off?
Nah. Like we always say, if it's not with IEA, find someplace. Find a. If you want to Google all day, do that. There are a lot of resources online to find education on the market. But we just know, Brent and I know from experience and from just being in the IEA community ourselves, that a community makes things a lot easier. It speeds learning, and frankly, develop friendships and relationships, and it could be future business relationships too. So a community is always, a lot better to learn than by yourself.
And sometimes you learn about alternatives, because
right.
I'm telling you, we're still thinking about this, how to work out like flipping shoes.
So, 1100% return. Yeah. I that one just sticks in my head. That 1100% up to 1100%, $6,000 for a pair of sneakers. People like it. Yeah. I used to I thought it was like a thing for teenagers to do. I didn't realize it until Rod did that live with us inside the members platform, that they're actually online exchanges for trading shoes and sneakers. Like it was unreal.
Okay, so we have our first, before we go to the thing, Beverly, we're gonna give you the picks. But Brian O's just told us that he bought 5 shares of Snow today. Brian, I would love to know what you bought. We knew Brian was gonna buy it.
Yeah, right. He was on that. He was on that for like a week or two.
But I would like to know, Brian, what you got in at. So if you have a chance to put that in the comments, I'm just curious, honestly.
Yeah, I'm curious.
Let's talk about it on the platform later on.
Yeah.
Okay, Leon, I'm ready.
All right. So my pick this week is a company called Atlassian. Again, company called Atlassian. The ticker symbol is it's the word team, TEAM. And Atlassian. So I actually have some experience with their software. So when I worked for Accenture a few years back, I used a product called Jira, and so that's kind of my connection to Atlassian. So I've actually used their products in the past, and one of the products I used was called Jira. So what they do is they specialize in software development, project management, and content management software. And when I work for Accenture, I use their project management software, the content management software, which was Jira, which is one aspect of Jira. And it made life a lot easier. So stats on them. So their 2-year average sales growth is 35%, and their 2-year average profit growth is a whopping 53%. So a highly profitable company with sales growing like crazy. And over the last 12 months, the stock is up 34%. So Atlassian, ticker symbol TEAM, TEAM is my pick.
All right. So if you have the name, it's Atlassian Corporation, PLC. The ticker symbol, please note this one is TEAM, because this one does not match the company at all. So
right.
Sometimes we get those ticker symbols that are a little tricky. This could be one of them for you. So the ticker symbol is TEAM. The name of the company is Atlassian.
And they picked that ticker symbol because it's a play on what they do. Like their software is for teams to collaborate, to work remotely. So that's why they picked that name.
Okay. So I'm going with an old staple, DocuSign. So DocuSign has been in the space where, I'm going to leave up the negative side of it for a while. DocuSign has been similar to Zoom. They're one of those COVID winners, right? And in that COVID winner space, they actually are making money, and where some of these companies are just getting hype. And so DocuSign is not going anywhere. It's certain they call consumer behavioral changes. And right now we're experiencing a drastic consumer behavioral change in the marketplace as it relates to companies like Zoom, Teledoc, DocuSign. They've always existed. These companies are not new. However, people were not they weren't forced to use them. In this environment, they are being forced to use them. And DocuSign, Zoom have been innovating and recreating themselves in very innovative ways, which is the reason why I like them. Now, when you look at the 5-year chart, that's why I didn't want to show it at first, because I know it's down today, but we really, on the ticker symbol is DOCU. It's DocuSign's my pick for today. I wanted to leave the negative ticker numbers up because emotionally it shouldn't bother you when you see a 1-day negative number next to a stock you're interested in. So for anybody watching this, and for those listening to the podcast later on, the chart shows DocuSign having lost 2.48% today, down $5. And you might think, oh my gosh, why would you pick that? It's a loser. No, Leon and I don't pick any of the, we very rarely pick stocks for instant momentum play. We pick stocks we think will be here in the long run, and they fit our buy and hold strategy. So when you switch to a 5-year chart and you realize that just in 2018, DocuSign was at $46 a share, and they're now trading close to 200, it's a completely different chart. It looks like a whole lot of green. So, they're not a dividend paying company. However, they are based in San Francisco. Their range is right around that $300 is their top end for 52-week high. So they were trading way below below the 52-week high. I think they're very attractive at 197. I think there will still be some corrections going on in pricing as we move towards the election and weeks after the election. Come January, you're going to see the market kind of get back to where it wants to be. But volatility is an absolute over the next couple months. So my pick is DocuSign. Leon's pick is, say it again, Leon.
Atlassian, ticker symbol TEAM, team.
Yep. So for today, we thank you all for being with us, and we will see you all next week. And for those who are in our membership platform, we probably going to do something in the membership platform very soon. So you all will be seeing us shortly. All right. Have a great day, everybody.